Hi, welcome to the Interaxis channel and Interaxis.io. Today we want to talk about the STABLE Act. And the STABLE Act is an act that has been proposed by a few Congress people to basically try to halt the creation of stable coins. Not really try to halt them, but to try to make any protocol or any company that is trying to release stable coins have to register in the U.S. as a bank and have to get its banking license and therefore go through FDIC and the Fed. First, I want you to remember to subscribe to the channel if you're watching this on YouTube. Follow us on Twitter at Interaxis8. Now, we're going to talk a little bit about the STABLE Act, and there's so many people, especially in the cryptocurrency world, talking about the STABLE Act because it has such far-reaching effects in the world of cryptocurrency and for the ethos that cryptocurrency was created for and continues to build for, and that is very disturbing. It also has very poor ramifications in terms of what it means for how Congress, how the government thinks about financial education and how the government feels about innovation in this country and the power that the United States wields. So that has some very far-reaching effects. We might get into that a little bit. It gets a little theoretical and philosophical to get into those discussions, but we still think it's very important. So first, what is the STABLE Act? So the STABLE Act essentially is going to call on the U.S. Constitution. It's going to call back to the U.S. Constitution, Section 1, Article 8, Clause 5, which says that Congress can basically coin money. Congress has the power to coin money and to regulate the coining of money, which says that I can't go create some sort of currency. Every bank can't go create its own currency. Every state can't go create its own currency. And in doing so, that Congress has the ability to stop people from doing that. And that actually kind of makes sense because you don't want a whole bunch of people trying to go create all their own currencies. That would make it very difficult for commerce within the United States and even outside of the United States if everyone kind of had their own currency going. So Congress says, look, if you're in the United States, you use the dollar, that's our currency, and we get to decide who creates that. And more importantly, we have the Fed to help us work with us to help determine the value of that currency and to help keep the value of that currency strong. So that Congress has the power to coin money, and they're kind of calling on that. They're also calling on the Federal Reserve Act that was created in the 30s that kind of created what the Federal Reserve is going to do and gave these mandates to the Federal Reserve that said your job is to manage the value of the dollar. They've called into account banking regulations, federal banking regulations that give the Fed and the federal government, the states, the ability to give banking charters. So they're calling into effect all of these past regulations all the way back to the Constitution and moving forward, and saying we don't believe stable coins are following this, and we as Congress are going to kind of put an end to it. And so the way they're doing this is they're saying if you are issuing anyone who's issuing a stable coin, right? So if I issue a stable coin, and the issuers of stablecoin is a little nebulous as well, but if I issue a stablecoin, I have to register as a bank now. So I have to go through, get a banking charter, I have to have an account with the Fed, all of these things that banks have to do. Well, of course, that's a long process. Now, here's an interesting question. You have the stablecoin DAI, right, which is done by Maker, which essentially is a DAO. This is a protocol. This is just out there on the Ethereum blockchain. So now Maker, this protocol, which is not a person, it was started by people, and the DAO was essentially run by people who are token holders. However, it would have to apply for a banking license, or you could no longer have DAI. Now, not only are saying you have to, there has to be a banking license issued for anyone who's going to create some sort of stablecoin, but any smart contracts or any transactions using that stablecoin that is not registered as a bank is therefore illegal. So if I go send you DAI for some sort of service, or just send it to you because I want to, or we enact some sort of smart contract that utilizes DAI as the payment mechanism, that is now an illegal transaction. Beyond that, anyone who is actually running Ethereum nodes or running some sort of blockchain nodes that processes transactions, that in somewhere in that pool of transactions there is even one transaction that involves a stable coin that was not issued a banking license, that is illegal. So the node operator is now operating illegally. That is essentially casting a net over the entire world of Ethereum node operators and saying, according to the United States government, you are now doing something illegal. And that's a pretty wide net. So when you start with something as small as stablecoins and understand how important stablecoins are to the cryptocurrency and DeFi ecosystem, and you realize that essentially DeFi and what we're trying to accomplish can't run without stablecoins, you go, this is essentially going to bring to a halt, potential to bring to a halt so much of the growth in decentralized finance and cryptocurrency, because you can't have stablecoins. Now the question is also, what will it do to something like Bitcoin? Because Bitcoin is not a stablecoin. It is actually the very definition of not stable. It's more volatile. But the problem is Bitcoin is traded on so many exchanges where it's instead of trading against a dollar, because those exchanges don't want to have a bunch of dollars, right? They trade it against USDT, which is commonly known as Tether, right? So you trade Bitcoin against this, and now what you're saying is, okay, any of these exchanges that use USDT are now illegal as well, because USDT is not registered as a bank. So now what do you do on exchanges? How are you going to trade Bitcoin? How is anyone going to trade Bitcoin against dollars unless these institutions, unless Tether and USDC and some of these others have registered as banks? And by the way, in registering as banks, part of the law, part of this regulation says that not only do they have to register, but they have to keep an equal number of dollars on hand as the number of coins being issued. Now, at the present time, Circle's USDC is the only one who does this. They actually have dollars on hand for all of the USDC coins that are issued. And what they've done, what USDC has done, is they've actually created smart money, and they've integrated, of course, now with recently with Visa, and they've integrated with some others to be able to create this smart money and say, look, we have the dollars sitting in the bank. We're going to issue these tokens so that you can move them around the blockchain, which is much more efficient than moving around the banking rails. So now, what essentially the Stable Act is doing is saying, okay, if you're going to issue a stablecoin like DAI, like USDC, like GUSD, which is the Gemini stablecoin, like USDT, you have to register a bank and you have to keep a dollar for every one of those. What that does is it takes away the innovation of somehow creating some sort of algorithmic stablecoin, a stablecoin that pegs itself to the dollar, but doesn't do so necessarily always one-to-one. It pegs itself to the dollar in an algorithmic way, which means it gives incentive mechanisms for people to contribute collateral or take out collateral or take out loans to try to keep the value of that DAI, in this case, at a dollar. And if you don't understand this, we have several videos on stable coins and how they work, and that might be helpful and interesting. So again, Congress is calling on the Constitution, old banking laws, the Federal Reserve Act, all of these, to try to put an end to stablecoins. Now, and putting it into stablecoins would put an end to so much of decentralized finance, because we have to have something of stability, because cryptocurrency has been volatile, and there has been so much progress made in trying to create some stability, some programmable money that you and I can feel confident about, that when we exchange it, and not only when we exchange it right now, but when we exchange it in the future, when we put it into a contract that says, I will pay you X number of tokens, USDC, DAI, GUSD, that are worth roughly a dollar at some point in the future, I'm counting on the Fed and Congress to keep the value of that dollar the same, and this token will represent the value of that dollar. So if I'm going to pay you $100,000, but later in the year when you deliver some sort of services to me, and that's in our contract, and we've denoted it with a smart contract, the only reason we can have all that infrastructure, and the only reason we can have that smart contract that makes our lives much more efficient, is because we have something of stability. We can't have that smart contract based on Bitcoin or ETH or something else, because the value of those could change wildly, and then the value of our transaction changes dramatically. And that's what we can't have, and that's why stablecoins are so important. So trying to make stablecoins register as banks essentially could potentially end all this great innovation in the world of stable coins, which really is trying to get us to stable money and a stable currency. Now, we're going to talk a little bit about what some of the reasoning is. First, we are not in any way, shape, or form completely against regulation. Regulation is highly necessary in there because in the absence of regulation, you kind of have this free-for-all. And in the very, very long term, a free-for-all might kind of be okay. A free-for-all in terms of complete laissez-faire capitalism might be okay. But in the short term, people get hurt. Okay, so the point of regulation very often is to protect the have-nots from the haves. It's because those with power, in the absence of regulation, will take advantage of those without. Okay, and we've seen this time and time and time again in this country. Someone, some organization, some entity, some group builds up a tremendous amount of power and is able to take advantage of those below them that don't have that power. It happened early on. It happened with trusts. It happened with monopolies. It happened with employers who took advantage of employees. And so we have all sorts of employment law that says you as the employer can't take advantage of the employees. We've seen it with banks. We've seen it with investment companies. There's so much regulation that says I, as an investment advisor, I, as a financial advisor, have to be honest with you. I have to have a fiduciary standard with you. That's all regulatory to make sure that I don't take advantage of you and make sure the financial system doesn't take advantage of you. Okay, so when we had 2007, 2008, the financial crisis, that was more of regulation that needed to come down from the top, because what happened is you had those in power, you had those bankers, you had people who were trading these mortgage-backed securities back and forth, and then insurance and collateralized debt obligations in an effort for themselves to try to make millions and billions and trillions of dollars on top of the people down at the bottom. So that was so any attempts to regulate there had to go to the top and say, hey, you guys need to stop trying to make millions, billions of trillions of dollars on top of everyone else. The difference here is this is innovation that has come up from the bottom. This is people at the bottom going, look, we're going to take this technology that we have and we are going to try to lower the power of those at the top. We're going to try to disintermediate. That's the whole point of this. Okay, and this disintermediation tries to get rid of some of the fees and some of the friction. Okay, because the fees and the friction is what makes it hard for those at the bottom, for those that don't have power, to get involved in the financial system and the banking system. So, in this act, and the rhetoric that's come out after it has said, we want to make sure that we protect those that are at the bottom, the low-income people. Because at some point there might be some sort of scam or some sort of way that they think that by holding USDC in a crypto wallet that they're holding dollars backed by the full faith and credit of the US government, when in reality they're only holding a cryptographic token that might or might not be backed up by actual US dollars. And therefore they might have the rug pulled out from under them and they have no money. If you're a bank, you have FDIC insurance, and if there's a run on the bank, then the federal government's going to come in and make those people whole. When in reality, if you have USDC in your crypto wallet and Circle up and goes away and there's no more USDC coins, then you have no one to fall back on. Now the problem with that rhetoric and that line of thinking is so many of those people on the bottom don't even have bank accounts. And if they don't have bank accounts, they're not at all protected by the federal government. They literally get their money cash from one place and go give it to someone else, or they get a check and go to a payday loan place or a money order place or check cashing and get a payday loan to be able to pay their bills, and they don't even go through the banking system, so you're not protecting them anyway. So the difference here is you have infrastructure that has been built and innovation that has come actually from the bottom specifically to take some of the power away from the banks. If you give all that power back to the banks, you're giving them even more power and you're not addressing the problem. And if the problem is you want to help the middle to low income people, what you do is you take this innovation that we have, which says, look, now you can potentially transact with this. And we're going to find ways to take USDC and DAI and help you understand how to use that so that you can get paid today and pay your bills today, and you don't have to pay 10, 12, 15% to be able to get a payday loan. Okay, so that would be better. So let's take this innovation, let's add, of course, education around finances and help get those people more participation, right? Because that's the whole point of cryptocurrency and DeFi, is increased participation in the global financial system. The fact that we don't have to go through the fees and the friction, we can get rid of that because we have decentralized finance, and that decentralized finance can come in the form of Bitcoin or ETH or many of the other chains that are out there that are trying to create this. And stablecoins are a huge part. And if you say stablecoins have to be regulated as banks, what you're saying is the US government is now going to have purview over all of blockchain, all of crypto. So one of two things will happen, or maybe both things. Either banks will start buying up, and because they already have the charters, they will buy the technology and coin it for themselves, and you'll have JP Morgan and Bank of America and Wells Fargo creating their own stable coins. They're allowed to, and they're going to use technology like Circles and like Maker and such to create their own. And they're going to have even more power, because now not only do they have all the fees and the friction that they can put on there on top of us, but now they actually have the power to be able to create this digital money, this smart money, and use it around the world, and they're going to be the only ones with the power. Two is you are going to have people going to other countries and creating the stable coins based on that fiat currency, so based on the euro or based on the yen or based on the yuan or the Australian dollar or something. And they're just going to create it based on that because the U.S. government doesn't have purview over that. And if you then say, okay, but no one in the U.S. is able to transact with those because that's part of the laws. You can't transact with a stable coin that is denoted with someone else's currency, some other country's currency. Then what you're going to do is you're going to form a financial island. And the U.S. is going to be a financial island if the rest of the world starts adopting blockchain and crypto-based money. And China's already adopting it, and the EU is already adopting it, and England's already starting to adopt it. So all these other countries are starting to go the way of digital currency, and if the US is going to put an island around ourselves and say, look, we are so big and powerful that we can do this, we're going to be a financial island, and we're not going to be able to take advantage of this efficiency. Interestingly enough, if you look at the Constitution, two clauses after the clause about coining power is the power over the Postal Service. Now, this rule would kind of be the equivalent of if in the early 1990s Congress looked at email and said, no, you're delivering mail, you're delivering messages, email system. So anyone who delivers any sort of message, any system that delivers any sort of message has to have a stamp on it from the U.S. Postal Service, because we got to protect the Postal Service. That's actually Clause 7. Clause 5 is coining money. Clause 7 is the Postal Service. So they didn't do that, and look at the growth in the internet. The internet would not have been able to grow if you were not able to actually send messages back and forth. That is one of the most important parts of the internet, is the ability to send messages. If you had to put a stamp on it every time, we wouldn't have the internet where it is. We wouldn't have growth in technology and innovation. And keep this in mind. The power of the US dollar is not in the fact that we're protectionists, not in the fact that we protect it at all costs, this power of the dollar. The power of the US dollar is the fact that it's backed by the US. And the US, the power of the US and the growth of the US is in the ability to innovate. We got to be the most powerful country in the world, probably in the history of the world, because of the ability to innovate and have capitalism on top of that. The fact that we can create innovation, find inefficiencies, and find ways around that, and help that grow and foster that and make businesses and employ people, that is what grows the U.S., which backs the U.S. dollar. It's the equivalent of if a company like Apple said, you know what, we're not going to put all these features in the new iPhone that cannibalize the iPod, because the iPod is our thing. Right? No, they said, no, how are we going to look forward and take advantage of our technology and our innovation and keep propelling the company and everything we can do forward? The power of the US dollar is not in our ability to protect it. It's in the ability to continue to make the thing that backs it grow. And if the company behind it, the United States, grows by fostering innovation and by saying, we're going to take this innovation and bring it down to those people who are not in the banking system and bring them into the banking system and bring them into the financial system now, and allow them to participate, we grow the U.S. so much more, which means we grow the value and power of the dollar. And if the dollar is what everything's being pegged to, whether they own dollars or not, that is the power now. So look at how you can innovate, educate, get those people to understand how to use these cryptocurrencies, how to understand how to use stable coins, incorporate it into their business and their lives. Then you grow this, which means you grow this. And all these people creating these stable coins can grow as well and have this innovation, and they don't have to go offshore somewhere else and create it there. So it's all going to start with education, all going to start with understanding what the real problem is. And the real problem is not stable coins and the creation of money. The real problem is these people that don't have access to the financial system. What we saw with the shadow banking system and the run-up in debt around the world, and the shadow banking system, again, there's another video about that, but the fact that the shadow banking system essentially means that you have the Fed creating U.S. dollars, right? Which means they technically, they print money, as we say. They're not technically printing it, but the Fed is deciding how many dollars they're going to be, right? But what you have is banks that are lending money. And they don't necessarily have to have the money sitting in their accounts. They don't have to have the money to actually lend it out. What they're doing, though, is the banks are taking the need. The banks and other companies are going, look, we got someone who came in that needs to borrow money. We're just going to lend them money. We'll figure out everything else in the accounting entry, and we'll take the risk that if everyone defaults on their loan, yeah, we got a problem. But if we've done our underwriting correctly, we're actually creating more money at the point that it's needed, which is down here. We're not waiting for the need to trickle all the way up and ask the Fed to create more money. Banks have been creating money for years. For at least 13 years, they've been creating money by lending. What you're doing now with stable coins is you're going all the way down here to the personal level, and you're getting even farther. People who aren't even in the banking system or in the financial system yet because it's been too expensive and there's been too much friction, now we're creating money down there because that's where the need is. And we're not waiting for it to trickle all the way up and for them to filter money all the way down. And again, all these fees and all this friction along the way that still keeps these people from being able to participate in the system. Where if we could just focus some time and some effort and some budget on educating down here, it would trickle up a level of value that would be unbelievable. Because if you look at what the internet did in terms of worldwide value and growth, this has that kind of potential. And I'm not just talking about stable coins, I'm talking about cryptocurrency and the decentralized finance nature in general, because of all the people it can bring into the system and all the efficiencies it can create. This is the internet plus money. And that's what is so important. And it sounds like we're some cryptocurrency focused people that all we want is crypto to take off and be great, but that's not it. We're not concerned with the value of particular cryptocurrencies. We're concerned with the use cases. We're concerned with the amount of participation and the efficiencies it can bring, the cutting out of the fees and friction, the taking away of some of the power of some of those entities who force themselves down on everybody. So that's, we're talking about the Stable Act, whereas we agree that there needs to be some sort of financial regulation in so many things. We need to have financial regulation in securities that are offered to make sure people to make sure there's not fraudulent. We have to make sure that there are some sort of regulations there. We have to make sure that these people are not taken advantage of. But cutting off the entire system to make sure that the people near the bottom are not taken advantage of is not necessarily the way to do it. You punish those people that do act fraudulently, that do act maliciously, but you don't necessarily take away the entire system, because the entire system can actually help the people at the bottom more than it hurts them, and it helps the entire economy, which in effect helps everybody. So if you want a chance to bring the US back and to get back ahead in the blockchain races and back ahead in the digital finance, decentralized finance races, then you need to actually spur on innovation. You actually need to be able to help the companies that are creating stable coins. Figure out how to regulate it in a way that keeps it safe for these people, but still gives the ability to innovate and grow. So that's a little bit about our thoughts on the Stable Act, and I apologize if this is really long, but there's a whole lot to talk about and dissect, and I know a lot of people are talking about this right now, but we felt like we had to address it as well. So we hope you enjoyed this. We hope you'll subscribe, and we hope to see you in the next video.